Nickel prices just hit $19,000 per ton in January 2026. That's a 30% surge in less than a month. At the same time, the International Lead and Zinc Study Group is forecasting a 261,000 metric ton surplus of nickel for this year. The London Metal Exchange is predicting a similar glut. So let me ask you something. How does a metal with a massive predicted oversupply suddenly spike 30% in price? And more importantly, why did zinc hit a 3-year high of $3,430 per ton while sitting on a forecasted surplus of 271,000 metric tons? When you see which country now controls 70% of the world's nickel supply, you'll understand why these markets aren't behaving like normal commodities anymore. They're behaving like something else entirely. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. If you want to understand what's really happening in metals markets and why it matters for your portfolio, make sure to hit that subscribe button and give this video a thumbs up if it helps you see through the noise. Before we dive in, I want to know, what's your metals position right now? Are you holding physical, playing futures, or staying out entirely? Drop it in the comments. Here's what I'm going to show you today. We're watching two critical industrial metals enter a phase that looks like chaos, but is actually something far more deliberate. And the country orchestrating it just demonstrated they can move global prices 30% in 30 days while sitting on enough surplus to sink the market. That's not a free market, that's control. Now, let's talk about what normal commodity markets are supposed to look like. Supply goes up, prices go down. Supply goes down, prices go up. It's basic economics. When there's a surplus forecast of 261,000 metric tons of nickel, prices should be falling. When zinc inventories at the London Metal Exchange drop 85% in 6 months, prices should be rising. That part makes sense. But here's what doesn't make sense. Nickel prices collapsed to $14,430 per ton in late 2025, then rocketed to $19,000 in January, despite that massive surplus forecast. And Indonesia, the country that now controls 70% of global nickel production, didn't increase output. They cut it. Dramatically. Let me give you some context. 5 years ago, Indonesia controlled 30% of global nickel supply. Today, it's 70%. That shift didn't happen by accident. It happened through aggressive mine development, strategic resource nationalism, and a willingness to use export restrictions as a weapon. And here's the part that should terrify anyone who understands commodity markets. When one country controls 70% of a critical resource, they don't have to follow market rules anymore, they set them. This is what analysts are now calling the OPEC of nickel. And just like OPEC can restrict oil output to prop up prices regardless of global supply levels, Indonesia just proved they can do the same thing with nickel. In late 2025, Indonesia announced they were cutting nickel ore output from 379 million tons to somewhere between 250 and 260 million tons. That's a cut of roughly 120 million tons. The market reacted exactly as you'd expect. Prices spiked. But here's what makes this different from normal supply cuts. The surplus still exists. The International Lead and Zinc Study Group isn't forecasting a deficit. They're still projecting a 250,000 metric ton surplus for 2026. So Indonesia isn't cutting production to balance the market. They're cutting production to control the price while maintaining enough output to flood the market whenever they choose. That's not supply and demand, that's strategic manipulation. And before you think this is just about nickel, let me show you what's happening with zinc, because the same dynamic is playing out with a different mechanism. Zinc hit a 3-year high of $3,430 per ton in January 2026. The International Lead and Zinc Study Group is forecasting a 271,000 metric ton surplus for the year. Again, surplus equals lower prices in a normal market. But zinc inventories at the London Metal Exchange crashed from 230,000 metric tons to roughly 35,000 metric tons before recovering to around 110,000. That's an 85% inventory collapse. And when physical inventories disappear, spot prices spike regardless of what future supply forecasts say. The question is, where did that zinc go? What I'm about to show you next is the thing that took me years to understand about modern commodity markets. China now holds 75% of all nickel warehouse stocks at the London Metal Exchange. In January 2025, they held 55%. In 12 months, they increased their share by 20 percentage points. And they did it while nickel prices were at multi-year lows. This wasn't panic buying. This was strategic accumulation. China saw Indonesia asserting control over production, saw prices at $14,000 per ton, and made a calculated decision: buy physical metal at depressed prices and wait. When Indonesia cut output and prices spiked to 19,000, China didn't sell. They held. Because this isn't about making money on the trade. It's about securing supply for domestic manufacturing while denying that supply to competitors. Let me explain why this matters. 60% of global nickel demand comes from stainless steel production. And stainless steel demand is collapsing in China because of the real estate crisis. Chinese property developers are going bankrupt. Construction has stalled. New building starts are down. That means less demand for stainless steel, which means less demand for nickel. In a normal market, collapsing demand plus massive surplus equals price crash. But prices went up 30%. That tells you the physical market is completely disconnected from the fundamentals. The price isn't being set by supply and demand anymore. It's being set by whoever controls the physical stockpiles and the production capacity. Now let's talk about electric vehicles, because this is where the narrative gets really interesting. The green energy transition is supposed to be driving nickel demand through the roof. Electric vehicle batteries need nickel, specifically nickel cobalt manganese batteries. Those are the high energy density batteries that give EVs long range. And for years, the bullish case for nickel was simple. EV adoption goes up, battery production goes up, nickel demand goes up, prices go up. That was the story. Here's the problem. Battery chemistry is changing faster than the market anticipated. Chinese EV manufacturers are shifting to lithium iron phosphate batteries, LFP batteries. They don't use nickel. They're cheaper to produce, safer, and good enough for most consumers who don't need 500 miles of range. BYD, the largest EV manufacturer in China, is going almost entirely LFP. Tesla is using LFP batteries in their standard range models. And because China is the largest EV market in the world, this shift is gutting the long-term demand case for nickel in batteries. EV sales in China are surging. Nickel demand from EVs is flat or declining. The green transition is happening. It's just not happening the way nickel bulls expected. So now you've got Indonesia controlling 70% of supply, China hoarding 75% of LME stockpiles, stainless steel demand collapsing, and EV battery chemistry shifting away from nickel. And yet prices spiked 30%. If that doesn't make sense to you, good, it shouldn't. Because what we're watching isn't a market. It's a strategic resource game being played by nation-states who understand that control of physical commodities is more valuable than money. If you've made it this far, you're already ahead of 90% of investors who think commodity markets still operate on Econ 101 principles. But don't stop now, because the next part shows you exactly how this control is being exercised and why it's accelerating. Let's talk about what happened at Weeda Bay. Weeda Bay is the largest nickel mine in the world. It's located in Indonesia. It's operated by a consortium that includes Chinese companies. And in late 2025, the Indonesian government seized part of the operation in what they called an environmental crackdown. Now, environmental regulations are important. I'm not disputing that. But here's what you need to understand about the timing. This seizure happened right before Indonesia announced those production cuts. And the companies that lost control of parts of Weeda Bay were the ones pushing for higher output to meet global demand. The Indonesian government effectively removed the players who wanted to prioritize supply over price. That's not environmental enforcement. That's industrial policy disguised as regulation. And this is where it gets even more interesting. After the Weeda Bay seizure, Indonesia didn't shut down the mine. They restructured the ownership and control. The mine is still producing. But now production decisions are being made with greater influence from the Indonesian government. And what did the Indonesian government do immediately after taking more control? They announced output cuts. They went from 379 million tons of ore production to 250 to 260 million. That's a deliberate supply restriction by a government that now has the power to enforce it. This is resource nationalism in real time. Now let's look at zinc, because the mechanism is different but the outcome is the same. Zinc treatment charges jumped from negative $115 per ton to positive $100 per ton. Treatment charges are what smelters charge miners to process ore into refined metal. When treatment charges go negative, that means smelters are paying miners for the privilege of processing their ore. That only happens when there's so much refining capacity and so little ore that smelters are desperate for feedstock. When treatment charges swing from negative 115 to positive 100, that tells you something broke in the supply chain. What broke was smelter capacity. Smelters in Kazakhstan and Japan cut production. Some shut down entirely. Why? Because the economics didn't work. Zinc ore prices were too high, refined zinc prices were too low, and energy costs in both countries made it impossible to run profitably. So they stopped. And when smelting capacity disappears, it doesn't matter how much ore exists in the ground. You can't get refined metal to market. That's why zinc inventories at the LME collapsed 85%. The ore exists. The refining capacity doesn't. And rebuilding a smelter takes years and hundreds of millions of dollars. You can't just flip a switch and bring it back online. So now you've got regional supply imbalances, ore in one place, smelting capacity in another, and massive logistical costs to move material between them. And because refined zinc is what actually gets used in manufacturing, the price of refined zinc spiked to 3-year highs even though the International Lead and Zinc Study Group is forecasting a surplus. The surplus is in ore. The shortage is in refined metal. And the market price reflects the refined metal shortage, not the ore surplus. Here's what Morgan Stanley is forecasting: zinc at $2,900 per ton for 2026. ING is projecting nickel at $15,250 per ton. Both of those forecasts assume normal market conditions. They assume Indonesia doesn't make another dramatic production cut. They assume China doesn't continue accumulating stockpiles. They assume smelter capacity comes back online. I'm going to tell you right now, those are bad assumptions. Because what we're watching isn't a market responding to fundamentals. It's a market being restructured around strategic control by nation-states who understand that the green energy transition creates leverage over countries that don't control critical mineral supply chains. Let me tie all of this together, because when you see how these pieces connect, everything changes. Indonesia controls 70% of nickel production. They can cut output whenever they want, regardless of global surplus forecasts, and spike prices 30% in a month. China controls 75% of nickel stockpiles at the LME. They can absorb supply at low prices and release it strategically to stabilize domestic manufacturing while denying supply to competitors. Zinc smelting capacity is concentrated in a handful of countries, and when those smelters shut down, regional supply chains break regardless of how much ore exists. And both nickel and zinc are critical for the green energy transition. Nickel for batteries and stainless steel. Zinc for galvanized steel and renewable energy infrastructure. What you're watching is the commoditization of geopolitical leverage. Indonesia, China, and a handful of other resource-rich nations have figured out that controlling critical minerals gives them more power than controlling currency or debt. Because you can print money. You can't print nickel. You can restructure debt. You can't restructure a supply chain that takes a decade to build. And the countries that don't have domestic supply of these metals are now completely dependent on countries that do. That dependency is leverage, and that leverage is being exercised right now. Here's the part most people miss. This isn't just about nickel and zinc. It's about rare earths, lithium, cobalt, and every other mineral required for electrification, renewable energy, and advanced manufacturing. The same playbook is being used across the entire critical minerals complex. Consolidate production in a few countries. Use export restrictions and production cuts to control prices. Accumulate stockpiles when prices are low. And watch as countries without domestic supply scramble to secure access at any cost. The United States has zero nickel smelting capacity that can match Indonesia's scale. Europe is in the same position. Japan imports almost all of its critical minerals. And all three are committed to aggressive decarbonization timelines that require massive amounts of nickel, zinc, lithium, and rare earths. They have demand. They don't have supply. And the countries with supply know it. Now we're in the home stretch. And I saved something important for the end. The real question isn't whether nickel and zinc prices will stay elevated. The real question is whether Western countries can build domestic supply chains fast enough to regain some level of independence. Because right now, they can't. Permitting a new mine in the United States takes 7 to 10 years. Building a smelter takes 5 to 7 years and requires hundreds of millions in capital investment. And even if you fast-track every project, you're still a decade away from meaningful domestic production. Indonesia built its nickel dominance in 5 years. China secured 75% of LME nickel stocks in 12 months. The pace of consolidation is faster than the pace of diversification, and that gap is widening. So what does this mean for you as an investor? It means commodity markets are no longer purely economic, they're geopolitical. And if you're trying to forecast nickel and zinc prices using supply and demand models, you're going to get it wrong. Because the price isn't being set by the market, it's being set by governments with strategic objectives that have nothing to do with profit maximization. Indonesia doesn't care if nickel prices crash next year, they care about maintaining control. China doesn't care if they overpay for stockpiles today. They care about securing supply for 20 years from now. And both of them are playing a longer game than any private investor can match. Morgan Stanley says $2,900 per ton for zinc. ING says $15,250 for nickel. Maybe they're right. Maybe Indonesia doesn't cut production again. Maybe China stops accumulating. Maybe smelting capacity comes back online faster than expected, but I wouldn't bet on it. Because every incentive in this system is pushing toward more control, not less. More resource nationalism, not less. More strategic stockpiling, not less. And more price volatility, not less. Here's what I want you to take away from this. The green energy transition is real. Electrification is happening. Renewable energy deployment is accelerating. But the materials required for that transition are controlled by a shrinking number of countries who understand that control equals leverage. And they're using that leverage right now. Nickel spiked 30% in a month during a forecasted surplus. Zinc hit 3-year highs during a forecasted surplus. Those aren't market anomalies. Those are demonstrations of power. And if you're invested in this space, you need to understand that the rules have changed. Supply and demand still matter, but control matters more. Your future portfolio depends on understanding which commodities are controlled by whom and what strategic objectives those controllers have. Because the next time Indonesia cuts nickel output or China accumulates another 20% of global stockpiles, you'll know exactly what's happening. And you'll know it's not a market, it's a chess game. And right now, the West is losing. So tell me, do you think Western countries can build independent supply chains, or is this consolidation permanent? Drop your take in the comments. I want to know where this audience stands on resource nationalism, because this is the defining commodity story of the next decade. You're not just watching nickel and zinc prices swing, you're watching the architecture of global power shift from financial capital to physical resources. And the countries that control those resources just showed you they can move markets 30% in 30 days while sitting on surpluses that should have crashed prices. Let that sink in. And then ask yourself, what happens when they decide to move it 60%?